Hi, everybody, welcome back to Ox Talk. It's Monday, June 17th, 2024. Appreciate all of you tuning in to watch today. I know your time is valuable, and I much appreciate all of you being here. This channel is growing, and it definitely motivates me to keep coming out here and sharing information, trying to help to wake people up as to what is happening with this economy, with the housing market, with the job market, themes and things we talk about all the time. So please continue to watch. Most importantly, please share the videos with your family, friends, coworkers, colleagues, anybody that is prepared to keep an open mind and wants to understand the dynamics and what's happening here. And I have a little different perspective as a business owner, as a litigator. You know, I see a lot of this stuff unfold across my desk every day. Over the weekend, I shared a personal story of mine across two different videos about a personal foreclosure we went through about 15 years ago. So I have this experience and perspective that I can share with you, and I would ask that if you are not a younger generation, meaning someone in their, let's say even late 20s, 30s, 40s, please share these videos with them. I want to talk about a comment I received from a viewer yesterday, and his name is Paul. He said, I won't give his last name, well, it's posted, but he says, one of your younger viewers here at 31, it sounds like, appreciate the content and honesty on what happened back then. Obviously, I was pretty young then, so this coming crisis will be my first, trying to be as ready as I can. And my response to Paul was, Paul, welcome to the channel. I hope that you will keep watching and most importantly, consider sharing my videos with people your age. You are far ahead of most by paying attention to these videos and others like mine, and you'll have a ringside seat for the next crisis, which is unfolding before our eyes. And so to Paul, I want to thank you again for being here. I hope that you will heed my suggestion and spread the word with the friends of yours and family of yours that are your age. You know, I was just about 30 years old when I purchased my first home. A client of mine, a developer client, actually built the house for me. And I was there for about 5 years until I embarked on that disaster transaction that ultimately resulted in the foreclosure. We were smart with the initial purchase, or I was single at the time. And I look back and I regretted, to this day, I regret moving from that house. We had substantial equity in the house, or I did, and it was a great place. Obviously, that we had some issues there. I discussed on the video from Saturday. If you haven't watched it, please do so. But looking back, I should have been shaken to the point where I made such a drastic decision. So anyway, Paul, thank you. And for, we need to get the word out among the age groups that are going to be most impacted by this next crisis, okay? And that's not going to be the retirees for the most part. It's not going to be the people that have, made wise financial decisions, either have a home paid off and have other sources of sustenance and support and income. It's going to be, guys, the younger generations, those folks now in their 20s, 30s, and even their 40s that are feeling pressure every day, right, to keep up with the Joneses, buy a house, not just from their friends and family, but from, TikTokers and other YouTubers. And now is a great time to rush out and commit to a mortgage and buy a house. I would beg to differ on that. I'm going to share a couple of stories with you today about the housing market, and the final story I'll share is about the rising corporate bankruptcies in this nation and how that is going to translate into, yes, job losses for a lot of people across this country. And for the ones that rush in and buy real estate right now thinking they're going to miss the boat, if they happen to be a victim of the onslaught of continued layoffs that we're going to see unfolding throughout this year and into next, they're going to have a nightmare situation, and very likely could find themselves where they're unable to pay that mortgage and pay that monthly obligation. And we know what happens if that starts to unfold. Ultimately, it leads to a foreclosure of the property. On Saturday's video, I think even a bit yesterday, I said, look, you're going to start seeing in the mainstream media more financial products being rolled out the same way they did in 2004 and 5 and even earlier than that. These loans are great. Take these adjustable rate mortgages, take these 100% financing, and put a second on your house. It's no big deal. You can always refinance it. And look, that is not true. They don't tell you the full story. You cannot refinance it if the equity in the property falls below the value of the loan. You cannot refinance it if you lose a job or if you miss some payments on credit cards and your credit score takes a hit. You cannot refinance it if you lose your job and you no longer have a W-2 paycheck coming in where you can show the ability to make that loan payment. So many factors will influence ultimately what happens if you step into these financial instruments. And timing is incredible. There was a story today came out at Fox Business. Pay attention to this, please. It says Freddie Mac proposes product to help homeowners tap home equity without losing record low mortgage rates. And so look at the creativity continues, because see what's happening now, if we hear about this lock-in effect, a lot of people, they're saying 70-80% of homeowners that have mortgages have mortgage rates at less than 5%. And some of them are in the 2 or 3% range, okay? So no one's going to refinance out of a 3% mortgage to pull money out and then have the new loan or the new debt be at 7.5% or 8%. Well, I mean, I say no one, but most will not do that, right? So here's this new product. It says Freddie Mac wants to offer second lien mortgages to help homeowners locked into lower interest rate mortgages access their home equity. Freddie Mac's proposal would allow homeowners to access their home equity while keeping their low interest rate on their current loan. It could potentially be a cost-effective alternative to cash-out refinances at today's higher interest rates, according to the Urban Institute. It says Freddie Mac's proposal is more borrower-friendly because it would allow the homeowner to retain their first mortgage with its attractive rate while tapping into their home equity. And so, look, let's explain what this is. They give a couple of examples. If you were to just go with a regular refinance and pull equity out of your home, the payment would be based upon the numbers, and they compare it with this new wonderful financial product that they're trying to potentially bring onto the marketplace now. It says in one example, given by the Urban Institute, a borrower with a 3% mortgage rate on a $300,000 mortgage would have a mortgage payment of about $1,265. If this homeowner, whose home is now worth $500,000, were to take out a cash-out refinance to access $100,000 for their home improvements, the new $400,000 mortgage would carry an interest rate of about 7.25%, making the new monthly payment about $2,729. So if you're to refi out of a 3% mortgage now, pull a chunk of money at the new rate, the entire loan then gets reset at the new rate. Okay, so you're going to have a much higher monthly loan payment if you do that. Plus, you've just reduced the equity in your home by the value of the second you've taken out or the cash out portion. Then they give the comparison now, trying to, of course, spin this and sell it. It says, however, with Freddie Mac's new proposed product, the borrower would keep the current $1,256 monthly payment and take out a new 20-year mortgage for the additional $100,000, meaning you would take out a second mortgage or a second lien. This would add $965 per month at the assumed 7.25 interest rate for a total monthly payment, mortgage payment of $2,130. What they're saying is, well, under the prior scenario, without this great product, if you borrowed that money, your payment would be $2,729. Under their proposed type project, let's say plan or gimmick or financial tool or whatever it is, it would be $2,130. Says currently the Federal Housing Finance Agency, FHFA, is taking comments on Freddie Mac's proposal as it considers whether to permit the mortgage giant's product to come to market. Look, guys, the goal, it's pitched as an innocuous or a borrower-friendly situation. At the end of the day, the goal is always to get you borrowing more money, to make you more indebted, to make you more of a debt slave, so you're trapped in their system, okay? Now, am I saying, and they're going to try every trick in the book as we embark on this next collapse or wave of collapses, if you will. So, keep that in mind, because, the reality is that these lenders, while they purport to be your friends, are not your friends. All right, they're the first one that if you miss a payment, they're going to report to your to your lender, to your credit agency, and your credit score is going to take a hit. So, these are scary products. Be very, very careful. Are there situations where this kind of a scenario, would be let's say a last case alternative for you if you had some overwhelming emergency or something? Sure. But you have to understand how this is being pitched, all right? To tap into money to go make home improvements, or to tap into money now the next one's going to be to go ahead and consolidate, higher debt credit cards and get those paid off. But look if your home is your main asset, and unfortunately it is most people's main asset, you put that at risk. I did a video a few months ago about refinancing, people using their homes as a piggy bank to pay off other debt, or to go out and take vacations or what have you, buy cars. And I admonished, not financial advice or legal advice, I admonished against it and why. So go back and find that video. It was a few months ago about people using their homes as piggy banks. So I wanted to share that with you. I can't believe we're already at 12 minutes. I guess over the weekend, it might not have been a good thing that I took so long on those videos, because now I'm seeing how easily I can take up time, not intentionally, on these recordings. So I always try to keep my videos around 15 minutes, and I'm already well past, or I'm going to be past that. So bear with me. The next article was out of Newsweek today. It says housing market may hit breaking point, economist warns. I think we're already there. I'll just briefly touch on a couple of the points from the article from Newsweek today. Long term, it says, people can't just keep spending more of their income on their housing payment. According to Danielle Hale, chief economist at Realtor.com, told Newsweek it's going to crowd out everything else in their budget. And we know that the insurance costs are going through the roof. Taxes are I get comments from some subscribers about their property taxes just eating them alive in certain states. It says, quote, we're at a point where households just can't push the envelope any further on how much they can put toward their housing payment. And that is what is signaling a breaking point to me, according to Hale. And the prior article I just shared with you about pulling out home equity at whatever the rate is, that increases your debt burden and therefore increases your monthly payment. So keep that in mind, folks. Equity in your home, unless you sell your home and you literally take the money and put it in the bank or invest it somewhere else, it's not really your money per se, because you have to go borrow it out of your own asset, if you will, the house, and then pay it back over 20 years at some interest rate in order to access that money, okay? We no longer have a normal real estate market, according to Tom Hutchins, who leads sales and marketing at Angel Oak Mortgage Solutions. Homeowners sitting on cheap mortgages have contributed to limited listings of homes and decreased sales, with about 86%, listen to this, 86% of outstanding home loans in the U.S. at the moment at 4% or lower interest rates. Added into the affordability factors now, how many people also have extremely low interest rates on their current mortgage, it says, which is just keeping activity at a very low level. It says both listings and purchases, just transactions not just listings or purchases, but just transactions as a whole. You factor in the home price appreciation that's occurred since the pandemic, and with the current interest rate environment, I would agree it's pretty fragile right now, this guy says. Realtor.com estimates that this means that potential new home owners need to earn, listen to this, with current interest rates where they're at and the average value of these homes, potential new homeowners need to earn $6,400 more a year to about $120,000 yearly income to afford to buy a median priced home. You hear about those numbers? They're saying that you have to earn $120,000 per year to simply afford a median priced home in this country right now. So that obviously is a bit repetitive from some stories I covered last week, but nonetheless very important. Last story today, and I'll be quiet. Business Insider. Corporate bankruptcies. The U.S. economy is headed into a corporate bankruptcy cycle that will spike unemployment, okay? And this is from Danielle DiMartino Booth. I followed her for years. I think she has a lot of good input on things. And she says a wave of large bankruptcies is about to hit the U.S. economy. And that could spark job losses for a growing number of Americans. The Q1 Research CEO pointed to the climb in corporate bankruptcies over the past year, a sign that businesses are struggling under higher interest rates and tighter financial conditions. Corporate bankruptcies rose 88% through April of this year, according to data from S&P Global. It says this marks the highest number of bankruptcies recorded in the last 12 months, and that tally should continue to rise, according to Booth. 9 companies worth $50 million or more have filed bankruptcy so far this year, the fastest pace of large bankruptcy filings since the pandemic. Booth predicted that the number of large bankruptcies would climb to 25 by the end of June, surpassing the peak of large corporate bankruptcies during the pandemic. Okay, and what does that mean? These corporations, when they go bankrupt, are going to lay everybody off. Okay, no one's going to have a job at these institutions or at these businesses. Companies have signaled, okay, that they're pulling back on hiring and ready to make job cuts. Another 63,000 employers announced plans to lay off workers in May, while hiring fell to the slowest pace year to date since what year you think? 2014. You have to go back 10 years to find the time when employers where we had this slow of a rate of hiring. And that's from Challenger, Gray, and Christmas. So guys, if you lose your job, if you're not able to provide for your own income, make yourself self-sufficient. I mean, if you don't own your own business, and that's not always going to get it done, but look, it gives you some additional options. If you're a W-2 employee or independent contractor and you lose your job or your contract or your consulting agreement is simply canceled or terminated, if you don't have backup, you don't have 6 months or a year or more set aside to cover expenses, mortgage payments, medical costs, insurance costs, auto payments, food, all that kind of stuff that we need. you can find yourself in a very, very difficult position. So this is a sign or a precursor of things to come. Jobs are going to be cut. If you are reliant on a 9-to-5 job, please consider looking into some ways to start a side hustle or get some other source of income coming in as an additional, let's say, protective layer for you and your family. Okay, if you're a younger person, 20s, 30s, I guess younger than me, even 40s, look, from my personal perspective, rushing in to buy a house right now because your realtor is saying now's the time to buy, or your mortgage broker or your financial advisor is telling you you've got to get in the market now. Inventory is going to keep getting tighter. I would say take that with a grain of salt and pay attention to what's happening here, right? Job losses are going to start accelerating. I wouldn't be surprised if we see more bank failures start to accelerate into later second half of this year. So with that being said, I'll leave it there. We're at 20 minutes today, a bit longer than I like to go. I'll be leaving in about an hour to get my workout in. I'm preparing for a massive deposition to take place on Thursday with a witness. It's a party involved in a real estate fraud case that my client is the plaintiff in. So I'm going to be embarking on a slew of depositions in this massive real estate fraud case. This one we have the lender named, we have the escrow agent, all the realtors are named, the mortgage broker's named. It's an ugly one, so I'm working on that for the next week or so before my trial kicks off on June 28th. Officially, we start picking the jury on July the 1st. So it's going to be a crazy couple of weeks. I'll do my best to be getting content up here for you guys. Once again, each and every one of you is important to me, and let's keep growing the channel. Have a great evening. Bye.